Price actions is a popular trading concept used to analyze the price of the market. Being is a simple and yet a very powerful way to stop trading opportunities. But with so many misunderstanding about the price actions, it's easy to get confused, especially if you are a beginner. Today in this video I wanted to share the 5 price actions tips I wished I knew when I was started trading. Tips which I will help you to make better decisions when you have to press the buy or sell button. Reversals usually being with the sharp counter trending movements. Uh, Predictions when reversal is going to take place is the goal of the many price action trades. Unfortunately, there are many ways that actually predict when the reversal is going to take place based of the current price actions alone. Most methods include watching or the reversal to being upon the market research price point drawn from the past, like the support or resistance level or the supply or demand to the zone. When the market reach the level of the zone, price action traders will look to the signs that suggest to them a reversal is about to being in the market. The most common of these things would be something like the candlesticks pattern, such as the pin bar or NG factor is a candle from the inside of the zones of the level itself. Wish list there is okay to use. They don't really have to do so much confirmations or reserve is going to take place, mainly because they are the only shown to the candlesticks worth data. Using angle funnels to actually predict when reversals are going to occur can often be very difficult, and results is many false signals. What I tend to instead is look over the sharp counter to tend to the movement taking place once the market has been moving in the directions for the long duration of the time. Here's the example. You can see the group which caused this reversal that was really sharp and was constructed of the bearish large range candlesticks that contains very little evidence of the buy taking place during the movement down. There's the type of the movements you will often see cause the large of the reversals to take place is the market. Of course, they won't all look like this one, but they will all have the same features. When they occur, meanwhile, multiple large range candlesticks and a few candlesticks of the opposite type formation during the movement. When you see the sharp of the movement take place, you should mark the point where the move originated from as the supply demand zone, because if it has actually been created by the bank transit place in trade to make the market reversals, they will try to get to any of their additional trades place into the market around the same point, which is the point where the sharp movements originated from the and if you see the market moves into the supply or demand zones created by the sharp movements, and then you support common price action signals like the angle funnel candles, then it's actually a good side to make is go into the reversal and create another swing in the reversal structure. Second, don't trade pin bars that from the after the large movements have take place. Once the best way to improve your success rate trading pin bars is to not trade the pins which are immediately after the large movements has taken place. These pin bars have the very low the probability of the being successful, regardless of which technical levels they have confused with or how they're constructed. The reason why is because they mainly from the due to the bank trades transit points of their trades. If you look at the bearish pin bar, in this example, you can see that from right after a sharp movement higher has taken the place with by the trading Now, at the large point, the big players obviously want to secure some of these profits. The only way they can take the profits that they buy trades is if they have the buy orders entering the market. This means they have to take their profits when the market is moving higher. When their profits to sell order which come into the market as the result of the much bigger than the buy orders, which cause the market to fall and create a bearish pin bar. You can see the chart. Typically, price actions trades will see the pin bar and will think that it's a good signal to take to the short trade. Then the reality is that although the pin bar may cause the slight reversal to occur, it won't be the one before the market continues its up move to the breaks. Though the higher of the pin bar, which you can see that actually ends up happening in the example. So remember this. It's not the great idea to trade with the pin bars, which from after large movements have the breaks. Don't get more wrong. You will see the occasional pin bar cursed market to completely restore after the long range, but vast majority of them won't, at the least not long enough for you to make the decent amount of the profit of the trade. Stick to the training candles patterns which from the during active market hours. My next tips is to only trade candlesticks patterns which from the during the time the last asset is actually trade, and don't take the trade to the patterns which from the during impacts patterns hours. For example, if you are trading the Forex Euro USD, it's trading the most between the time of the London trading sessions begins and when the US sessions ends, after the volume drops of the significantly and after the volume drops of the significant and there are no big orders coming into the market, it occurs to significant move. Candlestick patterns you see from the during low activity periods have the low probability of the work out successfully. In this example, I've mixed some pin bars and some energy factor candlesticks that form during the active and inactive hours on the Euro USD. You can see that the pins which formed during the inactive hours also energy factor candlesticks after. During the impact cluster. If you look after the volume of the bottom of the chart, you can see that the candlesticks formations which formed during the inactive hours had far less volume than the formation that we created during the active hours. It really shows that the lack of the bank trades participations during their informations. Learn to read candlesticks momentum. Here's the few facts. Every candlestick you can see on your chart from the one time frame up to the monthly time frames tells you a story about the momentum. Every candlestick tells you the story as to who was winning the battle between the bulls and the bears. Now, an increase in the momentum happens when the price increase or decrease very quickly in a short period of time. Let's have the look at these two candlesticks, and let's ensure that the both of these candlesticks were formed into the same time frame. Let's say the order hours chart. Now tell me, which one of these candlesticks has more momentum, candlesticks 1 or candlesticks 2? If you say candlestick 2, then you are right. Let's analyze each of these candlesticks to really see what happens here. Candlestick 2 from the opening never made at a low during the early stages, which simply means that the bulls where it controls of this candlesticks from the opening price of the closing price. The fact that there were no candlesticks wicks on the easier of the candlesticks is another side that the bulls were in the control from the start to the finish. Candlesticks 1, on the other hand, have the opening it made a low, which means that the bears took control of the while. After that, the bulls took control of the drop to the price up to the, in a way, the higher price. And then bears took a bit of the control again by the driving the price down, but not sufficient enough to have the closing price below the opening price. The fact that the candlesticks 1 has the same the candlesticks length and the candlesticks 2 means that they both trade the same price range in the time frame, but the fact that the candlesticks 1 has the shorter body length compared to the second candlesticks. That's why the second candlesticks represents the stronger bullish momentum candlesticks. When we talk about the momentum, we mean that trend range. For that, you must analyze candlesticks, the ratio between the candlesticks and the bodies, and the ratio between the bullish and the bearish candlesticks. A few points that will help you to understand the momentum. One candlestick with the smallest usually signals high momentum. More bullish that bearish candlesticks also usually signals bullish momentum. Small candlesticks with long risk shorts increase and the lack of the momentum. In this example, you can see that during the first part of the start, the bulls were in the control. Candlesticks were more green and the bullish candlesticks were much larger, and the top of the things shifter with the many small candlesticks with the large sticks. After that, we started to see the change in the momentum with short bearish candlesticks and more bearish candlesticks than bullish candlesticks. With high and the lows that from a similar price offer lead to reversal. Analyze swing highs to the lows into the important parts of the bean to the provide action trade, but a little secrets, not a lot of the trades now. Is that where you can see the multiple swings, highs or the lows formations of the similar prices to the another. It's usually a strong side of reversal, maybe about to take place in the market. Here's the image of the two reversals. You can see that before each one of these reversals took place, multiple slight lows had the formation of the relatively similar prices to the another. The reason your multiple swings forms so close to the another is because the bank traded are never be able to do their entire trading positions placed into the market at the single price. This is because the size of the trades that are placed are so big that their sales ordering available to the market them to get to their trades exclusive. So what they have to do is to get to their buy trades place in the market. The price swing up and down to the generators orders, which they can use to get all of their buy trade placed at the different but similar price in the market. So the next time you see the multiple swings highs and swings lows forming at the similar price to the another, it could be early warning side the market getting ready to reversal. You want to see the market at the swings or the lower high to the swings to the back to the upside direct before the creating another spikes low or the high to the similar prices, whatever or other lows on the higher have formed. As always, if you learned something new and found value, leave us a like to show your support. Subscribe to our channel and click the bell icon to stay notified when we upload the new video. Until next time.